Well, it seems like Friday was a real shake for the financial markets. The US jobs data was so strong that it sent the Fed those flying away. Equities took a dive, the US yield soared, and the US dollar jumped for joy. Now, last week's events have certainly given the major currency pairs a new outlook, and we will talk about all that in this episode. So welcome to the new week with Swissquote's Daily Market Talk. 517,000, more than 500,000. So that's the number of jobs that the US economy added in the month of January. And to be perfectly honest with you, I fell off my chair when I saw the number. I mean, it's a monstrous gap with the 185,000 expected by analysts. And even if the seasonal factors may have affected that January report, well, I mean, 517,000 jobs is quite a monstrously strong number for a monthly NFP report. And it's not all, because the unemployment rate in the US unexpectedly fell to 3.4%. That's the lowest level since 1969, and the participation rate improved as well. And the wages growth has been parallel to the 0.3% expected by analysts on a monthly basis, and fell from last month's 4.8% to 4.4% on yearly basis. But that 4.4% was again higher than the 4.3% expected by analysts. So Friday's jobs report in the US was a monstrous beat from all perspectives, really. It was a monstrous slap on the Federal Reserve Dove's face, as these numbers that we read last Friday were nowhere close to an economy that is supposed to be slowing down and eventually enter a recession and then call for a rate cut from the Fed. And it's another reminder that the huge layoffs that we see in big companies, and especially in the big technology stocks, well, remain the exception to the rule. And finally, well, these jobs reports, I mean, all of them are really messing with the Federal Reserve and with Jerome Powell. Now, one of the most colorful reactions we got after the US jobs data last Friday was Summers saying that, well, there is the risk of a Wile E. Coyote moment, beep beep, if companies realize, as it has been the case for the technology companies, that there are too many workers and too much inventory, in which case we are going to see a fairly sudden drop, he said. Well, we will see that. It's certainly not happening for now, but what's more important at this stage of the game is how the US jobs data will impact the price dynamics in the US. So it is still too early to say whether the latest jobs data from the US is good or bad news for the financial markets. It is obviously bad news for the Federal Reserve, which is trying to loosen the US jobs market, which wouldn't loosen, but it would be less bad or less dramatic news if the impact of these job report on inflation isn't significant. So to tell whether the latest jobs data is bad news because the tighter or the very tight labor market continues boosting inflation, or good news because inflation actually remains on an easing path despite these rock solid job numbers, well, we will have to wait until next Tuesday when the US will actually reveal the latest January CPI report. And until the fresh news, well, Friday's jobs data is bad news for the financial markets, and even more so as the latest technology earnings, including, Apple, Amazon, and Google, easily missed the market expectations. So there was nothing last Friday to lift the investor sentiment at all. Well, the day started downbeat for the S&P 500 on the back of these morose technology stock earnings announcements. Then, some investors kind of came to buy the lows on the session on expectation that a soft jobs data from the US may actually revive the Federal Reserve Dows and send the equities kind of higher. But in vain, the sell-off in the S&P 500 only got worse as investors saw that monstrous 517,000 NFP read, and as a result, the S&P 500 closed the session more than 1% lower. Nasdaq 100 slid some 1.80%. The US 2 and 10-year yields jumped, as the tightness in the US jobs report sent the probability of a 25 basis point hike from the Fed at the next meeting from somewhere around 80% to nearly 100%, and well, somehow lower that probability of seeing a rate cut from the Fed later this year as well. And the US dollar jumped, and the latest jobs data will likely support the US dollar bulls at least this week, as we don't have much economic data on this week's economic calendar that could finally temper this Friday's monstrously strong NFP read and somehow remind us that the US economy is still somehow slowing. The Fed Chair Jerome Powell will speak at an event in Washington on Tuesday, and he will probably sound hawkish faced with the latest jobs report from the US, if he says anything about it at all. And well, Friday we have the University of Michigan's sentiment index, but nothing major really. So there is a chance that the US dollar extends gains, as I said, and the fresh selling pressure on the Japanese yen will likely give an additional hand to the Federal Reserve hawks in the coming hours on weekend news that the potentially new Bank of Japan governor Masayoshi Amamiya, who will replace Mr. Kuroda, will be dovish. So now we have to revise our outlook for almost all of the major currency pairs, as there has been a lot of developments since last week that changed the whole picture, because the dollar yen's latest jump above the 130 mark could now be sustainable in the short to medium run, and that recovery could actually extend past the 50-day moving average level, which stands near the 132.60 level, into the 133, the minor 23.6% Fibonacci retracement on October to January decline, and into the 136.67, which is the major 38.2% retracement level, and which will distinguish between the actual bearish trend in the dollar yen and a medium-term bullish reversal. Now, I still don't expect the dollar yen to reverse as medium-term bearish trend, but the upside potential is quite interesting at the current levels before a major Fibonacci level is challenged for a real change in this market sentiment. Now, same goes for the euro-dollar. The euro-dollar was heavily hit last Thursday after the European Central Bank lifted the interest rates by 50 basis points as expected, but the number of other 50 basis point hikes to come was reduced from many to just one more at Christine Lagarde's press conference following the latest ECB decision. So the softening ECB hawks after the European Central Bank decision last week and the confused Federal Reserve dose after the US jobs report last Friday sent the euro-dollar below the 108 mark for the first time in more than 2 weeks. And because the euro-dollar hit the psychological 1.10 mark just before the European Central Bank decision, well, many traders were and will probably be happy to call it a good trade and retreat to the sidelines. Therefore, there is a chance that we see the euro-dollar soften further throughout this week. We will likely see some support between the 106.85, 107.50 area, which shelters the 50-day moving average, the positive trend base, and the minor 23.6% Fibonacci retracement on the September to last week's rally. But the euro-dollar will remain in the positive trend as long as it stays above the 104.75 level, which is the major 38.2% Fibonacci retracement, and I don't see the pair sink below the 105 level with the information that we have in hand today. For cable, it looks real ugly, guys. If the Fed saved the pound from sinking badly by the middle of last week, well, the US jobs data released last Friday couldn't really divert a significant sell-off in the pound, and anyone who looks at the cable's price chart today could easily tell that this pair is under a decent selling pressure, and it's perhaps just a matter of time before the pair slips below the 120 psychological mark and hits the next major technical level, which is the 119.50, and which includes the 200-day moving average and the major 38.2% Fibonacci retracement on September to January sell-off. Now, a decline below that level, the 119.50 level, could smash the last sterling bulls, but at least, you know what, the falling sterling helps the FTSE 100 hitting fresh all-time highs, so that's a good thing. So yes, in summary, we begin the week with a decent outlook shift in the light of the latest macroeconomic events. And elsewhere, well, the Adani sell-off in India enters the third week and things go from bad to worse for Adani as an increasing number of banks don't accept Adani's holdings as collateral anymore. So that's quite bad news. Now, on the other hand, the Chinese spy balloon that was flying over some strategic points in the US and that has been shut down, and that actually resulted in Blinken canceling his trip to China, is a sign of renewing tensions between US and China right now, and that could finally throw a floor under the gold sell-off. But the price of an ounce of gold will likely see a strong resistance into the $1,900 level on the back of a stronger US dollar. And finally, crude oil is back into last year's bearish trend as OPEC did not change its output production target last week, with, however, a strong support expected into the $70 per barrel mark, given that the tight global supply and the Chinese reopening story still remain the major risks to the bearish trend in oil right now. So this is all for this Monday. I'm İpek Özkardeşkaya and thank you for joining me. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual, and follow us on Instagram, on Twitter, and on LinkedIn for regular market updates, and subscribe of course to our YouTube channel for daily market comments. I meet you again tomorrow, and until then, good day trading.